Are your MT5 Expert Advisors or trading bots delivering flawless backtest result, but are crashing or even failing in live trading? The truth is most fail due to curve fitting. In this video, I will reveal how this common mistake can wipe out your profits, and more importantly, I want to show you how you can avoid this mistake. So if you are thinking about buying or currently using an MT5 EA, you need to watch this video, as it could be the key to protect your account. So let's get started and move over into the terminal. Now I'm using my BYBIT MT5 platform and my V-WAVE EA for demonstration purposes, but this applies to all MT5 brokers and all MT5 EAs. So this is not just limited to BYBIT. Now, what is over optimization or curve fitting? The curve fitting is the over optimization of a trading strategy so that it will achieve perfect backtest results. Now, why is this the problem? The problem is that it is being optimized for past noise, not for future trends. And the easiest way for me to show you is to give you a live demonstration. So I've loaded my V-WAVE Expert Advisor. I'm going to be running it on Bitcoin on a 1 minute chart, and I'm going to start with a $10,000 account. Now I'm going to load one of my set files. Alright, so now I've loaded a set file that is not over optimized. And in order to curve fit it, I'm going to use my knowledge of what happened in Bitcoin over the last 6 months, because this is a 5 to 6 month backtest. And I'm going to show you what or how easy it is to curve fit a strategy. So I'm going to make a buy only strategy. So I'm going to set my max sell positions to 0. I'm going to set my stop loss to 0. I'm not going to have a stop loss. And I'm going to change my risk to allow basically the most money in my account, my $10,000, is allowed to bet per trade. Okay, so let's run the backtest. We're looking at the graph. All right, so as you can see, this is a perfect backtest. Let's go into the backtest tab. Now, as you can see, this backtest on paper looks extremely good. You've had 0 losses, massive profit, but inside this backtest, there are 3 hidden dangers. And now I'm going to tell you what 3 things to look for in order to identify a curve-fitted strategy. So the first thing is unrealistic profits. So this is a 6-month backtest, and according to this backtest, you have made 5,200% in 6 months. Now, according to any trading logic, this is an extremely unrealistic returns. So that is the first issue. The second issue is unbalanced drawdown. So if you see here, your balanced drawdown maximal is 0.27%, your balanced drawdown relative is 2.92%, your equity drawdown is 43%, and your equity drawdown relative is 52%. So basically what this is showing is that this strategy is holding onto a trade until it goes back into profit. Now the problem with this is that if it doesn't go back the other way, or doesn't go back into profit again and keeps going the other way, what's going to happen is your broker is eventually going to give you a margin call and will close out the trade. So when all of these numbers are very different from each other, this is what they call an unbalanced drawdown. Don't get confused with balanced drawdown, but this is an unbalanced drawdown. And the last issue is 100% profitable trades. Now, although not impossible to achieve in a expert advisor, it's still very unlikely that over a 6-month period you will not have one losing trade. So all of these things individually are possible, but in combination with each other, unrealistic gains, unbalanced drawdown, and 100% profit, this shows you that this is a curve-fitted strategy. Now, what I'm going to show you is how quickly a curve-fitted strategy can go wrong. So now I'm going to go, and all I'm going to do is just change this strategy, because it is originally a breakout strategy. I'm going to change the strategy to run on out of sample data. And what I mean by that is just by changing the times that it's running, it has not been optimized to run during this time. So now I'm going to show you, I'm just going to change the out of sample data and run the backtest. And if you look at the chart, your count has just been wiped out. And if we go back to the backtest results, you'll see that you've lost almost 8,000 in a single trade, basically losing 80% of your count. So that is the dangers of a curve-fitted strategy. Now I'm going to show you the opposite of a non-curve-fitted strategy and show you how a strategy should look when you want to know if the strategy that you've received is not curve-fitted. So I'm going to go back into my inputs, and I'm going to load the set file again. Right, so now I'm going to just run the strategy as is, because this is a set file for one of my live trading strategies. I'm just going to run it. So if you look at the graph, it's a decent equity curve, but you can see we are taking losses and gains along the way. Now, if we look at the backtest result and compare it to the previous results, we have realistic gains. Now, if you look at our drawdown, you'll see this is a balanced, with a D, drawdown. All of the numbers are around about the same, within a percent of each other. So our balanced drawdown maximal is 4.52, balanced drawdown relative 4.76, our equity drawdown is 5.65, and our equity drawdown relative is 5.65. This shows a balanced drawdown, meaning that the strategy is using proper money management strategy. Okay, and the last thing is that you can see here our profit trades are 73% profit trades versus 26.5 loss trades. So as you can see, this is a non-curve fitted backtest. Now I'm going to run the same experiment that I did on the curve fitted one. We're going to test on out of sample data. And we're going to run the backtest again. Now, it is not as smooth as the equity curve on the previous backtest. But it still shows a profit, about the same as what it was when as the previous strategy we ran. But if you could see, the drawdown is 25%, and the drawdown is still balanced, even though it is quite high. So I would not use the strategy in live trading due to the large drawdown. I like to keep my drawdowns under, say, 10% max. Normally around 5% is where I like to keep my drawdowns. But you can still see the drawdown is balanced, and our number of lost trades are 51.22%. So as you can see, this curve fitted strategy, even though it was tested out of sample data, it did not destroy the account and it was still profitable. Now that you understand the difference between a curve-fitted strategy and a non-curve fitted strategy, I'm going to give you 3 pro tips to help you avoid falling into the curve fitting trap. Number 1, don't trust backtests blindly. Always backtest for yourself and backtest on out of sample data. Tip number 2, forward test your strategies. So always run your strategies in demo accounts or with a very small live trading account before throwing real money at it. The only way that you could test a strategy properly is by running it live. And tip number 3, which is for me the most important tip, understand the strategy that you are using. If you do not understand why the strategy is profitable or why the strategy is losing, you will not be able to trade it live. Especially you need to understand why the strategy is losing, because you will not know how to tweak the strategy to make it more profitable, or you will not know when to shut the strategy off, because not every strategy runs in all types of market conditions. So for me, if you do not understand why it is entering trades and why it is exiting trades, why it is winning and why it is losing, you must not use that strategy. Like, don't even get me started with AI bots, because we'll save that for another video. So now that you understand what curve fitting is and how to avoid it, if you want more pro tips on how to trade with expert advisors on the BYBIT platform or any platform for that matter, please like and subscribe. Until next time, trade smarter, not harder. Cheers.